Who's ready for the NFP, Warriors? No effing problem for us. How about you? Looking forward to reacting to the reaction? Hello, Miguel. Nice to meet you. Spencer? Is this your first time in face, Miguel? If so, you had a guardian angel lead you to the right place. Okay, so going into the NFP right here, we're getting this pullback in euro. You know, I don't know, call it trader intuition. I just feel like I'd fade a strong report. Not, you know, this bothers me in the euro that we had, you know, confirmed lows down there. Right here, even on the 1 hour. But when I look at things like the dollar right now, I could see how this could be a failing rally after the big break. Okay, so you got everyone bullish, then you got everyone bearish, and now you have everyone bullish again with this 97.80 being, you know, what was supposed to be such a critical line, and it's basically traded on both sides of it quite a bit. So we'll see what kind of number. I don't know what the whisper numbers are or what the major thing to pay attention to is, but I feel like I want to fade strength. So call me a chicken, and you know I am. I've been kicked in the teeth enough times in my career to, you know, look for a way to participate in case that turns out to be the scenario with lower beta. So what are bonds saying, Nick? I know yields have come back up. So, you know, I thought we were going to get one more drive in to the downside in yields. Where are they? But anyway, I'm probing the long side of euro pound here. It's still my contention, even if the dollar is good, it's not as much of a bet on something directional as it is that the euro will hold up better while the dollar is rallying than cable, or that the euro will outperform to the upside if the dollar is breaking. That's the bet. It's not as much of a directional bet on the dollar. I may add here at 61.8. So when I look at this, you know, this is choppy advance, could have been corrective, and this could be corrective. It looks like, you know, I'm sure Steve would say, we've been corrective since 2016, since this move ended. Okay, so I have too many fibs for you guys to really look at it here, but I'm thinking higher low. We're way off the lows compared to the euro, right? Okay, I mean, look at where we are. Look at this chart, okay, and here's a low, and then we had one higher low, and here's the euro just coming off one low, hasn't made a higher low yet, okay? So when I look at that EG chart, to me, it's a low risk play for me to try and see what happens with the NFP. You guys get it? And I've always been kind of constructive this and have been disappointed a few times with this 86.50 pivot on euro pound. You know, thought that we had a false breakdown. You know, and we tried it here, and reversed last week, followed through to the downside this week. Anyway, that's one of the positions I have going on. Yesterday, crude, I think, hit a very critical level. And, you know, I got out early. It was after my interview with Nick Santiago. And I'll admit it, I think Nick is very good. So I was influenced. He's looking for 68. But then we had this break right here. And you know what? He could still be right. Because look at this convergence here of these two moving averages. So this was my target, but you know, I'm human. Here's my thought process. I'd made some money. I'm hearing about Venezuela, all the stuff going on, a coup d'etat, and, the Russians telling Maduro to stay and all of that. And a guy I respect looking for 68. And I said, well, I think I'm just going to let go of it. And then I even tried to bottom pick it yesterday, and I was a little early. So after you miss a break, I just want to take you through psychology. Yeah. So the psychology was, I'll admit it, I was aggravated. I left $1.50, $2 on the table from my shorts when I got flat. And I started to see the possibility of a low. I didn't have any, look at on the crude. We confirm this low. We're bouncing here. But if we start closing back above 62.20, bears, I would be careful. Okay, this is very important, this pivot right here. So pay attention to that. So I bought it early, 62, and I scaled in, and I got out at 130, and I would have been okay because I paid, 62, 160, 130. The stop survived. It wasn't doing anything. And because I remember saying I was tired yesterday, okay? You know what? Don't trade when you don't feel great. All right? Because when you're under pressure and duress before a trade is working for you, it's not a coup? Okay. Okay. Well, I'm just saying. But and then you're on the other side of the trade and you're thinking, well, I missed it short. Now, I certainly I'm still in pain. I'm in the house of pain. Anyway, I can, you know what? It gives me an understanding of what people have to go through that are in chronic pain every day. People that have had surgeries that didn't work out and whatever the source of pain, that could wear on you too. So I didn't have the mental toughness just to stay with it because I didn't want to take a loss after missing the downside. Who goes through these emotional, mental machinations? And, I've been doing this a while and I still do. I just want to show you that, a lot of it wasn't as much the trading as, what's going on in your head. Okay, that's the battlefield. Your head, your mind, every day, right, Craig? So, the more disciplined you are, the more you're able to ignore the chatterbox in your mind. But I'll tell you something, when you don't feel good, it's not as easy to have mental toughness. And you need mental toughness every day you're in the arena. Yeah. And that's why, I really respect these young guys here. You feel good? All right. What a great attitude. All right. Oh, you mean it happened to you when you felt good? Oh, yeah, it could happen even when you're feeling good. I'm not saying it can't. But you know what? Focus on the fact that you feel good. All right. You lost a little money, but you feel good. Would you rather have made money and feel bad? So, always find something to be grateful for. So I'm very grateful for the team that I work with here. And I think anyone would be. And to hang out with you guys and then get to talk to David Brady, in a little bit. I learn from David every day. I have a great time doing this. Okay, so, I get to talk to interesting people and banter about markets, which are, after all this time, still fascinating to me. So, guys, I've been around, and people that know me know that I don't endorse anything that I really don't believe in. Okay, and I'm a big believer in ForexAnalytix. And if you haven't joined and you've been following me around from webinars and FX Street and everywhere else, I'm telling you, you're at the right place, and invest in yourself and then immerse yourself with these guys and hang out in the chat room after face and learn how to trade and learn new things from different people. You only have 2 eyeballs, so you go into private chat. Unlike face, it's completely interactive. All you could do is, ask questions here, and you guys can't see what questions the other attendees are asking us, or all the mean things that people have said to me that I have to mute my mic because I'm crying because I'm too sensitive. I have too much estrogen in my system. But you really don't do this for me, okay? Do this for you. If you're lazy,
Coach.
Oh, you got to get in there, buddy.
Yeah, it's NFP day, but
That's
yeah,
all right. Go ahead.
we have to take some charts. When
Go
I
ahead,
heard
man.
estrogen, I had to cut you off. I mean, it's NFP day. So
all right, man. I know no one cares about my hormonal problems.
Not today. Usually
okay.
I don't mind hearing about your, time of the month.
I
or
just feel
whatever,
a little uncomfortable with the extra water weight.
Okay. But I'm going to take over because we only have about 19 minutes until non-farm payroll, and I need to get through some charts really quick with the folks.
Go ahead, buddy.
All right.
I'm going to mute myself because I can't control myself.
That sounds good. Thank you,
right.
Dale. All right. So hey guys, so today's non-farm payroll, and as you guys know, the dollar is in a really tricky spot, and I'm going just so you all know, I'm going into this market flat. I had some Aussie New Zealand longs this week. Yesterday I took it off, when we were up here in the 80s because, I had a big core position, and I took it off because I'm a little worried about this little head and shoulder pattern. I don't like how the Aussie's playing out here currently, and I've made really good money in this over the last month, and it actually made my month last month. And if you guys listen to or watch the Real Vision piece, it was a really nice move ever since we broke through this 104.25, and I just been long and did really well. But I took most of it off up here in the 106, 107 range, and then I started adding back to the core position as we hit this 38% retracement. But I'm a little worried that we have this head and shoulder pattern. Amanda has been pointing it out, and I'm wondering, we might get a move back below the 105 level, maybe, some sort of deeper retracement here. So for me, I'd rather try playing it on the long side back down here, and then like somewhere down in this neighborhood, and then if we broke back above the 106.20 level, then I consider this is just be a bull flag type of pattern, nice consolidation, shallow, and then I could just get bullish again. But because of that, I took that off, and with the dollar, I played the dollar on the long side the last couple of days. It was great. I thought this was going to be a false breakdown, but now we're in a tricky spot because we do have to close the week in the dollar index here. And let me get rid of this arrow. You guys know I was bullish that the last couple of days. So, had a nice hammer candle, played the dollar long yesterday. I was not long the dollar overnight. I took my Aussie shorts off as we were sitting around 70 cents. And I said, I'm done with that for now until following this non-farm payroll. Now, the dollar, where we close, is going to be very important, because if you look on a weekly basis, and remember this is a weekly candle, so this can change. Right now, we had this breakout last week. We have to hold the breakout this week. So that means we have to close the week above 97.70. If we don't, that's a bit of an issue for dollar bulls. If this is a weak number now, I just got some information from one of the guys that's in our office. He said JPM which the JP Morgan desk payrolls model spit out a 266,000 jobs is what the headline number they're looking for. When you're looking at data, obviously the jobs report itself is the jobs number is going to be a big number, but more important, especially right now, is going to be average hourly earnings, and that's because the Fed is obviously, really concerned more about inflation, and one of the things that's going to feed into their inflation models is going to be, wages. So we need to see wages also continue to improve, and if they don't, that's going to be, a negative. So if we have a big beat, but wages come in light, I could see us fading like a dollar strong move if we have a good number and then a strong wage growth, then the dollar is going to sustain this breakout, in my opinion. So those are the two numbers we need to be concerned about. The good news is we don't have Canadian jobs report today, which that means we get to save that for next Friday, which is good, because I kind of like having them segregated between Canadian and US data, so I can just focus on one. I'm not the most skilled news trader, so when there's multiple pieces of data for Canadian and US data coming out at the same time, it takes me a little bit of time to kind of factor through those numbers and make sure that I'm hitting on all cylinders. So I like it that there's just the jobs data here. Now, with the dollar index, so if we have any spike up in the dollar index, you got to focus on these levels right here on the dollar index, I think. So it's going to be right through the 78% retracement, but you can see that spike high right around the 98.10 level. From 98.05 to 98.10. This is going to be pretty important. Now, support is just going to be the support zone. So you're talking about 97.70. Again, a close below 97.70, and if you're a dollar bull, you have to be a little bit careful, because then we're really facing a false breakout on the dollar index. Now, let's look at the euro, because obviously the euro is really weak, and we just stopped at the 78% retracement this morning. If you use ForexAnalytix, the last update from basic technical analysis was 59 minutes ago, and you can see we were testing the 144 level, and the hourly update was the euro dollar is pushing the 78% retracement at the 111.43 level as the hourly RSI reaches oversold ahead of non-farm payroll. Shorts should be a little careful. A bounce. Be careful of a little bounce ahead of the numbers. We are seeing that. We're seeing a little consolidation here. So, obviously, the euro still looks very weak. We have this AB equals CD that takes us down towards 110.60. Are we going to reach for that number today? I doubt it, but again, if we let's say JP Morgan's algorithmic model is correct at 266,000 jobs, and wage growth comes in at 0.3%, then we could be testing trend lows, meaning we could be testing 111 pretty quickly, and quite possibly take stops below 111. I have to imagine there's a lot of stops below 111 at this point. People that are long euro thinking that the dollar is done here, the data is going to start turning south, blah 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 blah. Anybody who's short the euros probably, or excuse me, long the euros probably has their stops somewhere below 111, somewhere down in this neighborhood. I guess that if we start taking out 111, we're going to be taking those stops. I just don't think we're reaching for that today. I really don't. I think the risk is actually the data does come in a little bit weaker. And so I think if you're dealing with the euro specifically, the euro back above 111.70 gets a little risky to be short. Okay. Now, again, I'm going into non-farm payroll with zero bias. A lot of times I go into the market with usually some sort of cross rate trade, whether I'm long euro Aussie or short pound New Zealand, or something like that. I have zero exposure right now, so I'm giving you a very unfiltered, unbiased look at how I feel about the markets, because I'm going to be reactive today. All right, so anyway, a move back above 111.70, I think is, would be the basis for a possible squeeze higher in the euro. So watch the euro, especially if the data is weak. Am I a euro bull? No, I'm not. Do I think Eurozone data is continuing to erode? Yes, I do. Although we have seen a little bit of an improvement this last week with PMI data, but I still think overall data is trending lower. We are going to be moving lower in the euro eventually, but that doesn't mean that we can't get a spike up over the next week to 113 and then back down again. So I'm when I'm going into today, I'm flexible, and I'm not going to let my longer term bias of being bearish the euro influence my decision making today. There was another interesting note from one of my coworkers. He put up a quote from a Credit Agricole salesperson. It says, every institutional investor I've talked to said, I'm why sell dollars? I want to buy dollars. It's the only place I really want to, be long at the moment regarding currencies, which I think it echoes the sentiment of the entire market. It's like the dollar is the least dirty shirt in the hamper right now, and there's a lot of dirty shirts in the hamper. Matter of fact, somebody needs to go do some wash. What?
Aren't you a little bit worried that this opinion has started becoming too popular? I was thinking about that yesterday.
Yes and no, but tell me, would you rather be buying euros or dollars right now? I would rather be buying dollars. I know it's a popular opinion, but
from a technical perspective, still dollars, no question about it.
Yeah.
But I'm a little bit worried that it's consensus now.
But if you look at the CFTC data, or let me pull up Adam's. Let me pull up Adam from Momentum Capital's free COT data. Look at currencies. And obviously there's going to be a little bit different read today, and we're going to see from Tuesday's data on. But look at speculative, look at dealer positioning, and look at speculative positioning. They're both about flat. So, opinion sentiment wise in the market, yeah, I think that the dollar is a little bullish on sentiment positioning wise, and we talked with and I mentioned we say our firm has talked with a few different banks. And positioning seems very flat. It was very flat going into the GDP numbers, or the FOMC this week. Institutional wise, they're pretty flat. So I hear you on sentiment. Positioning, it's not so much. All right. So there's a lot. In other words, there's a lot of room for institutional traders to continue to pile into the dollar. And even though sentiment is pretty bullish right now, it's not euphoric, but it's pretty bullish, and that shows up in the daily sentiment index the DSI that we talk about every day here, at least in our chat rooms. So anyway, let's talk about the cable. The cable, by the way, I think the pound has a lot of support down here below 130. So I'm not a cable trader right now. I'm really, just trying to wait for the Brexit, nightmare to be over with. But I think everybody is doing that. But I think the cable, any dip back down to 129.50 is probably going to find some pretty decent support. If you want to fade the dollar like on a strong number, the pound might not be a bad place to do it. So if the cable take stops below 130, that might not be a bad place to be thinking counter trend type of trade. I'll tell you this. I've had the Aussie. I had an Aussie short from the 70.40 level 2 days ago. Closed it all out around 70 cents yesterday. Made some pretty good money. I was was short a pretty significant position because of this pennant formation. However, you can see how we're on support. Now, I'm more interested in, what the hell is the Aussie doing down here when we have some supposed China trade deal coming and stocks are near all-time highs? What the hell is the Aussie doing down here? The Aussie is going to be the #1 candidate for an absolute beating in the event that the dollar strengthens or stocks weaken. When I say dollar strengthens, I'm talking about as a whole. Ultimately, I want to be short the Aussie. I'm not short right at the moment because, obviously there's a risk of, the support holding right now. But look at how weak it is on a relatively speaking, considering you're looking at any other currency pair. The Aussie is really looking like a pile of dog poo-poo. And that is a technical term. So obviously, the risk is building with the Aussie below 69.80. We could start to see some stops really, play out, but I'm not short. And I'd really prefer to see some stock market weakness alongside dollar strength in order to be shorting the Aussie. One last thing I'm going to cover before I turn over to my colleague Steve and Stelios here. Here's the dollar yen. I think the dollar yen's in this little, very, manageable, down channel. I don't think there's a whole lot to do. Obviously, with non-farm payroll, the cleanest chart or the cleanest move will be in the dollar yen based on a strong or weak piece of data. But what do you really want to do here? I mean, do you want, are you buying the dollar yen? I mean, if the dollar yen, starts making higher highs, I guess, you start making it above 111.75, then you can see you got higher hourly highs or intraday highs. I guess that's the way to play it if you can make it above that. Flip side is we do have lower highs, lower lows. So perhaps you can look for longs if we dip down towards 111. If we have a weak number and we hit new lows, maybe you play it off of this support here. Play it off this support.
Hey, Blake, before you go, do you think a strong report the market won't like? And I'm talking about S&Ps because it reinforces the narrative by Powell where he used transitory about 10 times, and then people realize there's no easing coming or hopium for quite some time.
Yeah, I think strong data could. Sorry, I was at a baseball playoff game until 10 o'clock last night, so 3 o'clock came around really early this morning. Thank God it's Friday. I agree with you. And yeah, so any type of euphoria that's felt in the equity markets off of a strong payroll number might be faded rather quickly. Based on your sentiment, so based on your comments, I kind of agree with that. So anyway, I'm going to pass it over to you guys, and I want to thank everybody here today. Steve and Stelios and Dale are going to be taking you through non-farm payroll live as they're happening. I have to get over and start trading myself. So good luck today, and thank you all for being here. Happy Friday. I'll see you guys on Monday. I'll be back here Monday morning on the Face webinar with my colleagues, this wonderful team that you guys are witness to. So thanks, everybody.
Thank you, Blake.
Good luck today.
Thanks, guys.
Webinar online.
Okay.
Hello, Steve's, plural.
Hey, Dale. We have about 30 seconds to go. So maybe, do we have any, we don't have any Canadian data. No, so it's just US. Okay. So I don't know which ticker.
Good hold on the crude short, Steve.
Sorry?
Good hold. Good hold on Steve's crude short.
Thank you, Coach. Thank you. We have 10 seconds for data.
Yes, we have average early earnings as well, but really the main event is payrolls.
USD yen here on the bottom right, Euro USD here in the middle top. Let me switch. There we go. 263. and 3.6 unemployment. 263 payrolls against 185 expected, and 3.6% unemployment, a drop to record low. Sorry. US average hourly earnings positive 0.2. You can hear the squawk talking here. By the way, speaking of which, this is a new tool we added in ForexAnalytix. It's called Data Flash that you hear. It's
look at all these push alerts.
As fast as Bloomberg. You can see it here, and it also speaks to you. So here it is. You can see the data here. It's very good. Let's see how the market is reacting to it.
Steve, the unemployment data, I think we can mostly ignore because participation rate fell by 0.2%. So that's
yeah, that's true, Stelio. But you know how it is. The market pays less attention to participation rate, while it shouldn't. Because don't forget that the big number, the nominal number, is the 3.6, right?
Yeah, sure, of course.
Yeah, so I do agree with you. It's mostly based on that. There's no question about it. But the market will still pay much attention to the headline. So in essence, even goods trade balance was better, minus 71.5 versus minus 73.
Yeah, it's better, but it's still negative 71.5 billion.
Yeah, that's very better than expected.
By the way, the previous reading, I think I remember reading that it was a record, and it's been revised even lower. So
now we're seeing. Let's go down to 4 hour charts. Now we're seeing the Euro USD pushing to new lows. So obviously, after this data, the dollar is strengthening. USD yen pushing higher here.
Fade it. Would you fade any of this?
No, I have no reason to do so. If you remember, Coach, I said here the other day that don't hold your breath expecting dollar weakness. And if you remember, I said don't count this as a false break higher because for the time being it's just a pullback, right?
I think Grega put something out when it turned the other day on the Fed, didn't he? A bullish view.
I didn't see. I've been very busy lately. I have no doubt. If that's what you remember, I trust your memory. That's how it is.
Well, I saw it on Twitter.
Okay. Okay. You want to have a freebie on Grega's point of view, having to do with the dollar? Yeah. Here it is. Because the market is still not doing anything. That's why. So you want to have a look at it. There it is. DXY. So Grega thinks that the DXY is
another high.
Is in an ascending wedge, as you see, probably one more high towards 98. Yeah. What is it? 98.50. I'm guessing, and this is the view on the daily. We had a triangle here as a wave 4, and he's expecting a wave 5 before a deeper corrective move lower.
Right.
Steve, that JP Morgan desk number was almost spot on. Watch these average hourly earnings. That's what's putting a little downside pressure on the dollar. All right, gotta go.
Okay, thank you, Blaker.
Thanks, Blake.
Thank you, Blaker. So that's what Greg expects, actually.
Okay, thank you, man. Thanks.
Okay, so by the way, keep in mind, more or less coincides with that. I have a horizontal support resistance area here in the DXY. You can see it dates back quite a lot at 99. So perhaps, that's the next area we're headed towards, the 99 area. We might find some strong resistance there, and then we might get what Greg is expecting, meaning, a reversal for, a deeper corrective move to the downside. Stelio, as long as we're monitoring the market and still nothing much is happening, we are seeing stocks being a little bit beat. I mean, let's go on the 4 hour chart, but nothing to write home about. I mean, they were already higher overnight. But, nothing really spectacular from as a market reaction so far. I would have expected, a bigger push higher from the dollar, but so far the reaction is muted. So Stelio, go ahead and give us the rest of the macro data as we're monitoring the markets.
Yes, well, not much actually, but we had Swiss CPI came in line, 0.7% year on year, really nothing to write home about. UK services PMI in line, above 50. The previous print was 48.9, now it's back to 50.4, so above, it's not contracting anymore. But this series is quite volatile, though, ahead of the Brexit conclusion. And the main number that we had today was a Eurozone CPI, which bounced back mostly as expected to 1.7% year on year. That's from 1.4% last reading. And we talked about this in the chat room with a couple of people. I personally think that readings like that, one-off readings, are not going to be a huge influence into what the ECB does. And as long as the rolling average is well below 2%, I don't think there's any worry about inflation in the Eurozone right now. PPI also disappointed a little bit. So,
by the way, Stelio, to advertise a new tool further, it even has extra tabs here. Here, active trader shows you visually.
It's fantastic. It shows you how much it gained or lost versus the estimate, which is versus actually, is it versus the estimate or versus the previous reading? It's versus the estimate, right?
Yes, exactly.
Yes.
And it's extremely fast. It's as fast as Bloomberg, actually. Amazing, but it is. Really that's a new addition for our subscribers. We see now stocks pushing towards the highs. So we're retesting this previous little high at 29.30. So it's interesting to see how stocks are going to react here. But for the time being, the stock market is taking the news as positive and not as negative. That was a valid question that you asked, Coach. Given the latest statements from Powell, if good news is good news for the market or good news is bad news. So far, it seems that good news is good news, but we need to give it a little bit more time. There is a question here from what I see. Let's see, we have several actually. There's a question from Spencer with the NFP result. Where do you think gold is headed now? I don't tie that so much with the NFPs. I can tell you one thing for sure is that gold is still holding onto this horizontal support area at 1265. So I can't advocate. I'm still holding my my remaining short position here, but I can't advocate to anybody to sell it right on support. It makes no sense, right? Where would your risk be? So I can tell you that I think that the path of least resistance remains to the downside as long as we clear this 1265 area. Now, if we rebound again from this 1265 area, I would be a little bit careful. I would definitely not want to see gold go above 1288, because then this might indicate that a corrective move to the downside has been concluded and we're headed higher again towards a key confluence of resistances at 1360. But as long as we remain below 1289, I think that the path of least resistance should be considered to the downside. So from a technical perspective, things are quite clear. Silver, on the other hand, has already broken below quite an important support area at 1480. As long as it remains below it, next downside target at the 78.6% fib at 1439. Let me see more questions. Can everyone hear audio? Yep, absolutely. Audio works fine. A lot of institutions were long the dollar a long time ago. I think it's more a question of hold, dump, or at this point. Let me see. Weekly USD does not look too good. No, EURUSD in general at the moment doesn't look good. Okay, there is the only bullish interpretation here for EURUSD is interpreting this as a descending wedge. But in order for you to confirm a move higher, we would definitely need to see a break above this horizontal support resistance area and this descending wedges trend line resistance roughly at 113.20. Okay, as long as we remain below that area, there is absolutely no reason why you would be looking higher, for a bullish reversal. Now, if we do break above that level, then we can be talking about a bullish reversal, in which case we can start measuring potential upside targets, with the first area of interest, in my opinion, being roughly at 115.50, if that happens. But until that happens, all that is just theorizing. What is, a fact is that we've had a very, very prolonged period with lower highs, which is the definition of a downtrend, and that is what we have in hand, and that what is that you need to respect. Okay, now USD Swiss. Keep in mind we had a spike lower the other day, highly correlated, of course, to Euro USD, inversely correlated, obviously. But look at this chart on the daily. We can see the spike there as well. Look at how many indecision. Let me zoom in so you can see it. Just count how many indecision candles we've had in a row. 1, 2, 3, 4, 5, 6, 7, 8. The vast majority of which pin bars, spinning tops, etc. So when you have a strong move higher and then you have like a sequence of indecision candles, usually that is, a good indication of a consolidation, right? So the most likely scenario here, something like this, bullish continuation pattern, in which case you would expect to see more upside. Of course, having this cleaner view here in the USD Swiss, that would most probably also mean at the same time another leg lower for Euro USD. Of course, what happens to Euro Swiss will influence that. So, for example, if we do break above this 114.50 area in Euro Swiss, that's definitely going to help the USD Swiss perform better to the upside than the Euro USD is going to be performing to the downside. And since it's now consolidating, I would have to think that USD Swiss still looks more appealing as a pair to trade in comparison to Euro USD. Okay, so if you have a thesis, I think better express it through USD Swiss, at least my point of view. When good news is bad for markets, big stocks, rate cut expectation
nice
falls.
reversal candle in Euro happening here, guys.
Let's have a look at it, Coach, on.
I kind of had a feeling you could fade this dollar strength up here. We'll see if it follows through, but you're getting a nice reversal candle.
Here you can see it on the 4-hour chart. It's a pin bar
higher
now.
low.
It's a hammer. Yeah.
You buy it with stops under the low, the move, and see what happens.
But too early, because don't forget that on Fed news, we also had the initial reaction. When I say the initial, I don't mean the first few seconds. I mean the first few minutes, completely reverse afterwards, Coach. So, I'm not a news trader unless, I will often trade the news on specific occasions. And one of those occasions is if I see that one market is reacting very strongly to news and another highly correlated market is ignoring that reaction. So, that's one of the few occasions I'm going to, trade on news. Other than that, I'm already positioned. For example, I closed, and not only that, I didn't want to take risk. For example, I wrote to the chat room, I closed my long USD NOK position for, if you remember, I was underwater for some time on that. I closed it for almost 1.8% of profit, simply because, speaking of that, because you can see it here, simply because we were stalling at this fib extension and quite close to this confluence of resistances at 882. So, the pair remains trapped roughly between 840 and 880. So, as close to 880 and ahead of the NFPs, risk reward didn't make any sense. I already had some nice profit, so I just, collect that.
I think that's what's great about Face, Steve, is that the different styles. Okay, I mean, I learned on the floor where guys would fade news events, and stop hunt. So it left an impression on me. It's my paradigm, and you've learned to not react to news unless you see a correlation that's out of line, that's telling you something. So, that's what's great. And Stell, he brings the fundamentals into it. Anyway, I think the diversity of Forex analytics is one of its biggest strengths, in my opinion.
Oh, I totally agree. And that's why we don't let each other influence the rest. I mean, the good thing is that we're all experienced enough to have our own opinion. And, I respect everybody's opinion here. And I know that they're right more times than they're wrong. That's why they survive by trading the markets. But after some time, you start to trust. You start trusting yourself because you see your performance being good, and although you're cognizant of the fact that if somebody else in the team might have a different opinion from you, and they're good traders as well. If you let every time this hinder your ability to make your own decisions, then you will just be doing nothing, right? So you just do what you believe is best. And when our opinions,
I know you respect Rega's work. I know you and Blake's and everyone, Steve. So when they're on the other side of a trade, what do you do to not let it influence you because you've seen them be right so often?
Nothing. I still follow my trade plan. You know what I mean? And usually, because trading, even the different disciplines of trading have many common rules. What happens is that when the other person's opinion that might be opposite to you gets verified, that was your invalidation point anyhow. You know what I mean?
And I found that people could have opposite opinions, and then based upon the time frame, both be right.
Yeah, and both
right,
make money.
Or even both be wrong.
Oh yeah, that's true as well.
Okay.
True as well.
Anyway.
So we have a question about what is happening here with the USD CAD. I really have no big clue, and let me explain why. I can tell you why. We've had a prolonged move to the upside. You can see it here on the 4-hour chart. But is this upside momentum what you want to see if you're bullish? Not really. So would I be long the USD CAD, with a medium to long-term time horizon? No, I wouldn't. But do I believe that the path of least resistance remains for a move towards this channel, for example, first before seeing a rejection or seeing a continuation? Yes, I do. So just by looking at it, in a shorter term, I can tell you that I do believe that as long as we remain above this trend line, this red trend line, we can see more strength, from the USD CAD towards 135.50, 136. But not something I would take a position on at the moment, I have to tell you. So, it's not that I have enough of a conviction or that the technical, picture here makes me want to trade, right? So I just, let it be at the moment. Indirectly, anyhow, not indirectly, I have a very correlated trade. I'm still short crude. If that plays out, it also means that USD CAD has a higher chance of overperforming, of doing well, I mean, in this case. So if crude keeps dumping, probably USD CAD will move to the upside as well. So another reason why, if I had to do something with USD CAD, that would be being long until proven that that's not the correct side of the market. On EURUSD, we've got wave 1 and 2, and wave 2 has deep correction, good place to go long. Might be the case, but I told you, for me to consider being long, I want to see a break above 113.20. Until that happens, I want to be flat. I won't be selling here as well. I want to be honest. So My favorite position in the EURUSD remains the same I had like 2, 3, 4 months ago, which is, just being away from it. Question: what is happening here with crude? Crude has clearly validated our thesis of a reversal. We pinpointed that very, very early. I was looking for a reversal either from 64 or 66. That's why I scaled in the trade. 66 ended up being the key
You have
level.
the high of the week, Steve, on the bounce at 4.5. The high was 60, so you're off, I think, 10 or 12 pips on that reaction.
Okay.
That was a great entry.
Yeah, and
nice
actually,
entry.
yes, indeed, we also gave people a nice rebound level, which we did hit, that they could enter if they weren't already in the trade.
Right.
Now what happens from here? We still have no clear indication if this is a corrective move lower or an impulsive move lower. In one case, you should expect a lot more weakness. For example, I would expect at least 58 to be hit. In the other case, who knows? We might have even satisfied the minimum expectations for a move lower. Regardless, I still have my short position. At the lows, I was more than 5% in the money. So, I'm going to remain a little bit patient. And in the short term, you should still favor the downside in the short term.
So if this is an ABC, Steve, a possibility, if it is an ABC, this could be a 4 with a 5 to come?
Yeah. One more little thrust lower, and that might satisfy a completion of wave C. Correct. And
I
then
was
we
thinking
might see
the other way, that we've had ABC from the highs back to trend, and that there could be one more launch, or that is a low probability in your view?
You want to speak Elliott wave? Let's give another freebie here. Let's see what Greg is thinking on.
Isn't it nice to have Greg at your fingertips, bro?
4-hour charts, absolutely. So Greg on the 4-hour chart. Let's see what he thinks. Yeah, as I told you, another leg lower at least. I thought you meant this is a wave 4, this one.
Okay. All right.
So yeah, he thinks more weakness as well. And as you see, he also does know. As you see, he has 2 counts here, either ABC or 1, 2, 3. Of course, if this is a 3, it's gonna, move deeper. It might move, deeper. So we don't know yet, right?
Yeah.
We don't know yet.
Okay. Thank you.
I do favor more downside though. And speaking of looking for resistance, I think that 62.20 to 62.50 should be area of resistance. So, trying out shorts there as well. Probably not a bad idea. But actually, if I see some nice price action, I might add a little bit to my crude short. Why not? I have no problem with that. Somebody's moving size today, says Joshua. Elliott wave has oil possibly going to 66, 68 still from around 60, but from 60 could have a big run higher. Yeah, if we do find support anywhere at 60 and we complete this as an ABC sequence, which will indicate that this was a correction lower, I'm totally with you. We should see new highs from there. I mean, new highs from the 66 highs. I don't mean all-time highs, right? Obviously. So yeah, absolutely. If this proves to be a corrective move lower, 68 is easily doable after that. Yes. Let's see if I skipped any questions from earlier. Steve, are you still holding to the oil short? I think we covered that. Dear Steve, yeah, we covered that. Good news is bad news. That was David Brady's comment, by the way. When good news is bad for markets, pick stocks. Rate cut expectations fall, stocks fall, DXY up, PMs down. I skipped any other questions. Alejandro says, hey coach, what is going on in Venezuela is not a coup. He's right about that. Coup is when you're trying to overthrow a government that is democratically elected. So indeed, that's not the case. the case in Venezuela. It's more of a revolution. The other guy, Guaido, is the legitimate transitional president. There is much. Yeah, if I remember right, this guy Guaido was the head of the dissolved parliament, right? Correct me if I'm wrong, Alejandro. So yes, I agree with you 100%. Was not self-declared president per the constitution. He's supposed to be the transitional leader. Okay, I think this covers the question. So let's go have a look. Silver. We already had a look at silver, but let's have a brief look at it once again. Bottom line here in silver, expect this previous huge support resistance area at 1480 to be resistance. So we broke through that level. It acted multiple times as support. So now expect that it might act as resistance. So I would be careful here because we might get rejected from there. GBP Euro spiking down. Do you think will continue? So probably you're referring to Euro Pound or Pound Euro. Anyhow, I always view it as Euro Pound, and of course the exact opposite is going to be happening to Pound Euro. As you see here, we were looking at this as a possible diamond bottom, but that's obviously not the case, because if that was the case, after breaking higher, we should have seen some momentum, some upside momentum, and some continuation higher. So nothing really to do here. I mean, this is like a prolonged consolidation. I won't be doing anything with it at the moment. Just look at it as a big range, let's say between 87 cents and 84.70. So like 200 and something pips of a range. Very, very mixed price action. I won't be doing anything with it at the moment, really. Of course, it's an ability to rebound, can be interpreted as a bearish sign, right? So a break below 84.80 most probably will bring a continuation and probably acceleration as well to the downside. What do you think about coffee Arabica? I mean at the low. Please give me a ticker. First of all, what I think about coffee Arabica, I like it. This is usually what I drink. But if you want me to have a look, yeah, if you want me to have a look at the commodity, since I haven't had a look at it, you need to give me a ticker. I can have a look at whatever you want me to have a look at coffee. But
okay, how about how does espresso look to you today, Steve? An espresso.
Espresso coffee, all these coffees, make basically,
the real strong ones that comes in a little tiny cup, and then you could drive from Greece to Grega.
Don't forget that espresso is the basis for a lot of coffees, right? So cappuccino, Freddo cappuccino. So yeah, I love it. I drink 2-3 every day actually, cappuccinos.
Yeah.
So give me a ticker, please.
Could never tell you're so calm.
Kerem says frappe. The problem with frappe, Kerem, is it's very tasty. There's no doubt about that. Is that instant coffee is really bad for your stomach. So although I love it as a taste, I don't really recommend it, for prolonged use. During summertime, on occasion, it's definitely lovely. If you ever visit Athens, I'm buying one. Okay, so coach, I know that David is here because he was commenting in the chat, and we are at the top of the hour. So why don't you start your interview?
Okay. Always look forward to talking to Dave. Hey, Steve, thank you very much. Great week. Nice crude call. Great to have you back in the saddle, man. So, David Brady on deck. Great to have you back, David. I always gain insights every time we talk. So, looking forward to hearing your voice. Let's see if you're unmuted. You are?
Testing, testing. 1, 2, 3.
Okay, 4, 5, 6, my trading warrior brother. How are you?
I'm great, Dale. How are you?
Good. Great to have you here. How are things going in Canada? Everything going okay?
Well, we've gone from
Maybe.
snow to rain, so I guess it's a small improvement, but I'm
Yeah.
still waiting for summer to show up.
Okay. Well, when's it get there? In June, July?
It should be this month, actually. May is usually the
Okay.
transition month, but you know, fingers crossed, it eventually shows up.
So, to talking about summer, what's on your heat map? Oh, of course, I should have expected a PowerPoint and a nice presentation. So, David, I'm going to do what's difficult for me and try not to interject a lot and be a listener and learner to what you have to say today, buddy. So, it's all yours.
Well, Dale, as you know, I prefer an interactive discussion rather than me pontificating about what's going to happen, but
Okay.
I appreciate it. And just a quick comment with regard to Stylianos's comments recently. I was sending all those comments because I was really enjoying what he was saying, and you know, in violent agreement with almost everything, which makes it a very dull conversation. But I was basically cheerleading in the comment section.
Yeah, he's one of the best. You
yes.
know, because he gives a wrap up. You could walk into the market with not one idea, and after listening to Steve for 20 minutes, you have a lot of things to consider. So, when's the last time we talked, David? 6 months ago?
Yeah, November.
Something like that?
Yeah.
Yeah, before the crash, you called that decline. You were there for the worst December since 1931. And then I remember you saying you're buying calls, and it was near the bottom, a little after the bottom. Did you expect the magnitude of this recovery to be new highs from the December, January lows?
I sent out a couple of tweets, one on December 24th, right at the lows. That was actually the day we bottomed, saying, showing the 2008 rally. I believe it was from November of 2008. We got a 27% rally in stocks. Just said food for thought, guys, because everybody was bearish beyond belief at that point. We were at 23.46, give or take. And that turned out to be prescient. I sent out another tweet on January 6th saying I expected us to go to 2,800 by at least the March FOMC. But to answer your question, I expected a rally to 2,800, but it's pretty much long in the tooth at this point. I still consider this a bear market rally until the market tells me otherwise.
What would that be?
Well, I'd have to see a break of 3,200 on the top side to really, throw in the towel, because as we'll go through today, when I ask bulls, what's your rationale for why the market should keep going higher? I either get silence or I get momentum and the trend is your friend and so forth. And I'm a trend follower myself. That's the only way to trade. But at the same time, look at how far we've come from December 24th. And my presentation, the bulk of it this morning, is with regard to stocks and the numerous signals that we're getting now that the risk reward has clearly moved to the downside. This doesn't mean that it peaks today, but you have to get ready for at least a pullback. But potentially new lower lows. Those are the two main scenarios on the table. So without getting ahead of myself, let me just jump straight in here. So I'm going to go through a whole raft of signals quickly because there's so many, and I haven't included them all here. So, but this will give you a taste of what I'm seeing. So, for example, the S&P, despite its rally, is still negatively divergent on a monthly basis. It's also negatively divergent on a weekly basis.
Right.
So those are two warning signals. This is the RSP versus SPX. This is the equal weighted index as a ratio against the standard S&P. And what I've seen in the past and what's happened in the 2008 crash is this tends to underperform the weighted index, the standard S&P, as a warning sign that things are everything under the cover isn't as rosy as you see in the big picture, which is the index level itself. So you can see here that the RSP peaked way back in December of 2016 and has never set a new high. Whereas, we know that the S&P has just continued to power higher here. And more recently, it's got a lower high and seems to be at a lower low, which basic trend analysis tells you the trend is down. And this is why, while the S&P continues higher, you've got the RSI, the MACD, both MACDs showing that momentum is not supporting this further rally in the S&P either. So this is a warning sign for the bulls that this rally is running out of steam. And this is a breadth indicator. This is basically showing that the weighted index is going to new highs, but the equally weighted index, which discounts the fact that the FANG 6 or FANG 8 are keep going higher, is showing a altogether different signal. And let's get into some more breadth signals here. Here's the new
summation index. Don Mead has been talking about this rally, the quality of it, the inherent McClellan type of stuff is not confirming this move either.
Well, yeah, I respect Tom's work to a great degree, and he was right in saying that when we broke out to the upside on the RASI, the summation index, that there was more leg room on the upside, and that has proven to be the case. But we're at elevated levels now in the RASI, and it's coming off. And we're seeing the same thing right here in the new high-low index, which shows new highs have relative to new lows has peaked and is showing a lower high. Now, normally you hear the bulls say, "But look at where it is." Yeah, I don't look at where the market is. I look at where it's going, and this signals to me that the risk reward is down from here, and we've got a lower high in the high-low index. And then let's look at the number of stocks above their 50-day moving average. Yeah, recently it was over 90%, but it's falling. You're seeing lower highs again in the number of stocks which are above their 50-day moving average, while the S&P is going to new all-time highs. This tells you that the number of companies participating in the end of this rally is falling. And that's a warning signal. And then again, look at the momentum indicators. They're all going down. So keep that in mind. This is the 21-day moving average daily sentiment index for the S&P. Now, this goes back to 2003. And the reason I show it is the average is at elevated levels, to say the least. The only time this has been higher has been January 28, just before January 2018, coming off the most bullish market ever, to use a politically correct term, in 2017, where we had, I think, the least amount of 1% moves down in history. And then you have to go back to the QE, post QE in March 2009 for higher levels, and before that, 2006. It's hardly inspiring in a QE-free environment. Well, we could debate that, but the Fed is still undergoing QT right now, and yet we've got the sentiment at elevated levels. This speaks to extreme complacency, and I see this day to day on Twitter when I get responses from so many people saying it's only going up and so forth. That just validates my theory that complacency is becoming pervasive. It's widespread, and that's another sign, like the mailman back in 2000 asking me about tech stocks, that you need to start looking in the other direction when everybody is on one side of the boat, as it were.
What was your reaction when you heard the Fed was going to stop QT in the fall?
Capitulation of the Fed. If you look at what happened in Q4, which, yes, predicted because of primarily, there were a whole bunch of reasons. I don't just throw forecasts out, I don't shoot from the hip, as it were. There's a lot of rationale behind it, but the main reason for that, I expected that fall in Q4, was global liquidity turning negative towards the end of the year, and the markets would anticipate it. And indeed, that's what happened. When the buyback blackout hit in October, and global central bank liquidity was turning negative as the ECB was tapering to zero on their QE, the Fed was maximizing its QT, moving up to 50 billion a month in October. When you take those factors, and liquidity is the primary factor driving stocks, let's make that clear. It's not earnings, it's not fundamentals, it's not the economy, it's liquidity, and that's the whole reason we rallied from.
It's financial engineering too, right, David? I mean, this whole tax cut didn't go into plants and equipment. A great majority of it went into stock buybacks, didn't it?
Oh, absolutely. When I use the term liquidity, I'm not differentiating between true liquidity from day-to-day investors and institutions buying the market and being bullish. This is the most hated bull market in history. It's artificial liquidity. It's coming from central banks, corporate buybacks, you name it. It's completely engineered, in my opinion. But that's the reason why the stock market fell in Q4, and it's also the reason why the market rebounded in Q1. And we'll get into that momentarily.
Okay.
Now here's the what I call the hockey stick, and this refers to the 2 10-year yield curve. And when the yield curve, everybody focuses on the inversion of the yield curve. That's not the issue. The issue is when the yield curve spikes higher after inversion. And you saw that in 2000, you saw it in 2006, which was where both before the crashes occurred in stocks. And the reason for this is yields are falling at both the 10-year and the 2-year level. However, the 2-year is falling faster than the 10-year. Hence, the spread between the two is rising. And why is the 2-year yield falling? Well, it's poor economic conditions, negative financial conditions, and the Fed is cutting interest rates. So it's a sign of trouble for the market. Well, you can clearly see it worked in both both those crashes. And recently, we're seeing signs of potential bottoming in this yield curve. And I'll move to the daily chart. And rising. We had the bottom was in December, and we've had higher lows since. We ran into a brick wall at 21 basis points. But ahead of the FOMC, everybody got ultra dovish, given Trump's comments and so forth. Yeah. And then the Fed funds interest rate and reserves issue, the difference between the two, and expected the Fed to cut rates. Well, that's the reason why this popped up above that 21 basis points. It's come back down because the Fed disappointed.
Like it could be a false breakout and we're headed lower. On that previous chart, David, one thing I did notice I wanted to ask you about, the other two examples, the red line was underneath the blue line, and here the blue line is underneath the red line. Does that mean anything? You see the difference between the two previous examples of yields beginning to rise in your previous slide?
It is going higher. Just give me a second here.
Yeah.
No, in both cases, no, it's just a graphical. It's just the way the graph comes out when you use a long-term chart versus a short-term. If you look at the axes, they're the same and going in the same direction on both. So this is going up in yield terms. This is the S&P falling, and you're seeing the same here.
I see.
This is the S&P falling, and this is yields going up. So, so that's the hockey stick, and this is I call it the dreaded hockey stick because it's been extremely prescient for the prior two crashes. And if we see this happen again, you're gonna get an advance warning because it happened a few months. It was shorter in terms of duration, the lag between the bottom in this and the peak in stocks in 2000, but you had a much bigger window of opportunity to short stocks in 2006. And if we see this spike higher, which personally I believe we will at some point, because I do believe that the Fed is going to be forced to reverse policy at some point in the near future. and they've been warning us about it since Powell was nominated. But we don't have to try to anticipate when this spikes. We just have to wait and watch it happen. And when this shoots higher, then you can feel more comfortable about getting short stocks in a big way. Now, this is another bond market indicator and credit leads. This is the high yield index. The high yield spreads relative to treasuries compared to the stock market. Typically, as you've seen in the past, these move basically hand in hand. They're very closely correlated on an inverse basis. But now you're getting high yields are diverging from stocks. High yield spreads are rising. Everybody talks about how great the return has been on the high yield index recently. But when you compare it to treasuries and you look at the spread, it's actually widening. And it bottomed way back in November, and it's still going up. Stocks, on the other hand, are also going up. It's supposed to be an inverse correlation. So something has to happen here to close this gap. Either high yields spreads come down or stocks come down. So that bears watching too.
Okay.
Then we've got the 10-year and the 30 years themselves. The 10-year yield peaked back in 2007 ahead of the S&P and dumped. And in October, last October, when the stock markets dumped, the peak in yields occurred, and you can see it here. And to the extent that this continues lower, it's obviously a negative signal for stocks, because why would bond yields fall dramatically? It's for a number of reasons, because negative economy, negative market conditions, and a substitution effect, because if stocks are falling, those flows are going to move out of stocks into a safe haven like bonds. And that's one of the primary reasons you will see this drop. So we've seen it peak in October and fall, but we haven't seen yields go back up after the rally in stocks in December. They're still down. And you've seen the same thing in the 30-year. And I love this 100-month moving average, by the way.
Wow.
It's been tested so many times over the past 20, 30 years. And it broke out briefly here. And I posted a tweet back then saying, buy bonds at this point because it's going to go back down. And here we are. Now we've got a nice little bounce here. But the monthly MACD, especially in the 10-year, is telling me that this has a lot further to go before yields bottom. We had the highest peak in history in October, and now we've got a long way to go to get back to these levels for a bottom in yields. Again, what needs to happen with stocks in order for yields to drop so precipitously? Stocks have to fall.
Yeah, flight to quality be the next part of the bond advance.
Yes, and then after that happens, the Fed reverses policy to QE, which means the Fed is buying bonds again, specifically treasuries, and the yields fall even further. So, so let's look at the VIX now. So the VIX has, back in 2007, we saw higher lows in the VIX ahead of the peak in stocks, and we're seeing the same thing again. Everybody's focused on how well the VIX is performing and it's supporting stocks. But when I look at it on a monthly basis going back to 2017, the higher lows, higher highs, that's an uptrend.
Yeah.
And we saw the same thing before the peak in stocks in 2007. So yet another warning signal even from the VIX. And then I have this. This is the futures chart for the VIX. Large specs are at all-time highs again. And look what happened the last time they peaked. The stock market didn't peak initially, but
these are people selling volatility.
Yes, shorting the VIX.
Okay.
And
a few products disappeared.
Yes, but they're still doing it. They're obviously still doing it.
Okay.
The future didn't go away, and they're shorting. They found another way to do it. They're shorting it in the futures market. But as you can see, we can debate this. But having monitored the COT data for a long time, and Stylianos can jump in on this too, is that the specs are the dumb money, and what that means is they're wrong at extremes. So when they're all-time short at the most in history, typically it means it's going in the opposite direction. And the same when they're long. And this chart clearly shows that. They got long down here back in 2018, post the 2018 January 2018 sell-off. Stock market went up. Then they got short again at the all-time highs in stocks, and down it went. They got long again at the bottom in December, and up it went. I mean, this isn't rocket science. And now, here we are again, and they're back up to all-time highs. These guys never learn. And the risk is when you couple this, and this is just the VIX. We talked to the bonds, we talked about negative divergences, etc. When you couple this with this, I'd be nervous. I mean, you've got an uptrend in the VIX itself as the stocks are going higher, and you've got the dumb money holding record short positions. It's a recipe for disaster.
Do you position yourself in any kind of VIX derivative, or it's just an indicator for you?
It's just an indicator from you. I don't play the VIX. I'm not in that game.
Okay.
It's just a personal preference. I choose not to. I'd rather.
No, that's fine.
Yeah, I'd rather.
There's a lot of decay. They're almost like options sometimes because of contangos, and it makes my head explode. So I completely understand.
But it's a fantastic indicator. I mean, look at this as an indicator. You can go back to 2015 or before, and it's the same deal.
Especially when it's going up and the market's making new all-time highs. It's really a pretty good tell.
Well, we just spoke. I mentioned the word complacency earlier, and this screams complacency again. I mean, we just had a 20% sell-off in stocks, and already, due to the market rally and the extent, this is what I was talking about. Bear market rallies are designed to pull everybody back in, and then pull the rug underneath from everybody. And it's done its job extremely well, and it's not done yet. But this, if you look at the data and put aside your emotions, the data is telling you trouble is brewing here. This can go higher, of course, but the bigger they are, the harder they fall. And when I look at this and I look at the other cacophony of indicators, it says to me loud and clearly that this rally is running out of steam. The only debate that we should be having is, do we get a pullback, a healthy pullback, or are we going down to new lows? So,
would you mind if I switch gears a little bit? Crude has topped last week at 66.5. It's had about a $5 sell-off. Do you think that they have been Siamese twins? Although the S&P way outperformed crude, they went down together, they rallied together. Is a potential top in crude another indicator? And then I also wanted to ask you about your view on precious metals as well. When this happens, is that going to be the time that we get a catalyst to the upside in gold?
So I'll deal with the first one first and come back to gold. The WTI, I agreed with basically everything Stylianos was saying earlier, and I see a rebound in oil here, potentially to a higher high. I'll be looking for a negatively positive divergence of that higher high to signal a top. But
so you're looking for over 6650, the high we put in a week ago.
The 50% fib, yeah. I'm saying it's possible. The other alternative, I'm expecting a rally, a rebound. Whether it goes to a new high or not is in question. But we could get, the second scenario is we get a nice rebound, but we fall short of that 66.50 level, and it goes low. But I still expect stocks to, go a little higher here. I'm looking for north of 3,000, and in order for that to happen, you can't have the WTI dropping to the 50s or the 40s. I mean, as you said, oil and stocks have been fused at the hip. So I think oil's nice. That's their healthy pullback, and I expect a rebound at some point here shortly. But this is just my opinion. But whether it goes to new all-time highs or not all-time, new highs or not, that's in question. But certainly a rebound. With regard to gold. I've been saying, God, I write for Sprott Money for over a year now, that my primary scenario for a bottom in gold is a reversal in policy by the Fed to rate cuts in QE. All we've gotten is talk so far, and that precipitates the peak and fall in the dollar. And at that point, gold and silver will spike higher. And we got a taste of that ahead of, just around the FOMC. When the FOMC disappointed people with who had dovish expectations ahead of it, the S&P fell and metals fell too. But gold went back up there briefly. And let's talk about the dollar as well. The dollar ahead of the FOMC fell in anticipation of a dovish Fed, and then when the Fed disappointed, it spiked higher immediately. And there's a fantastic chart of dollar yen right at 230, where you've got a massive green candle right after the announcement. So gold fell as a result initially, but then as stocks continued to fall down to 2,900, gold caught a bid. And this was a sign to me, even though the Fed basically did nothing, it told us a few things. It told us that if the Fed is dovish and does revert to rate cuts in QE, the dollar will indeed fall. That's what it did pre the FOMC. And then when they disappointed, the dollar spiked back up. Stocks fell after the disappointment, and they were rising into the FOMC. So you got a clear indication of what would happen with the dollar and stocks. And this plays into your question, Dale, what happens to gold? Well, if stocks start to fall and then the expectations for a rate cut and QE, a return to QE, rise, you would expect, I expect, the dollar to fall and gold and silver and the precious metals and the miners, obviously, as well, all to rise from that point. That's my primary scenario for the bottom in gold and silver, is a Fed reversal in policy.
You really think, David, it's going to be that easy? All we have to do is wait for the day for the Fed to announce that they're lowering rates and starting QE?
I think it's actually going to happen ahead of that. I think, as we just saw at the FOMC, that the mere expectation that the Fed is on its path to cutting rates and returning to QE will send gold and silver higher. And said, is it that easy?
You have levels that are attractive to you?
Yeah, I have. At the tail end of this presentation, I was actually going to go through gold. But
okay.
A quick comment on this. This isn't just me shooting from the hip. Go back and look at 2008 and what happened with gold. Gold bottomed in October 2008, 6 months before stocks bottomed, even though QE was already underway. So gold anticipates, and it rallied from $700, $800 to $1,900. Given what happened with the recent FOMC and the action in the Dixie pre the FOMC in anticipation of a dovish Fed, why would we expect anything different this time? I mean, we can get into the dollar too, and the trend is your friend, but as you can obviously tell, I'm not a dollar bull. I expect a peak and fall in the dollar shortly, and for the reasons I just mentioned, because two of the primary reasons for dollar strength is dollar illiquidity, dollar shortage, and the other one is relatively high yields compared to the rest of the world. Well, if the Fed reverses policy, you've just solved both of those. You're pumping dollars into the system again, and you're going to see yields fall. We talked about the hockey stick and the bond, the 10-year, and the 30. So that relative outperformance relative to the rest of the world, that's another leg of the stool that's pulled from underneath the Dixie. So that again plays into my thesis that when the Fed does decide or is on the path to cutting rates and returning to QE, that you will see the dollar fall and you'll see gold and silver rise.
Okay, do you think the dollar peaked recently at that 98.30, or some of the super dollar bulls are talking 99.20, 102, and then there's guys like Hendricks thinking 107, 120, something like that. Where would be some decent levels, or is it more about, again, waiting for the Fed to verbalize their shift to easy policy?
Yeah, or to actualize it. Yes, I have had 98, 99 on my radar for quite some time as the peak. I think it's going back to July of last year, the peak in the Dixie. I also said in multiple tweets, but you could get an overshoot to 101.60, and we could get into Fibonacci levels and so forth.
Okay, so that's still on the table, 101.60.
As an extreme, that's my overshoot. But 98, 99, we hit that. We could go back up there again and then fall. But to answer your question about the 107 and 120, I posted a few tweets there about 2-3 weeks ago, and I know there are two clear camps on the dollar right now. You got the dollar bulls, and there's a lot of very well-known names in that camp, and you got a few others like myself and Luke Groman in the other camp, looking for a dollar peak and fall. And the problem I have with the dollar going to 107 or 120 or 160 is, look what happened in August 2018. Everybody seems to have short-term memories. The dollar went up to 97, the Dixie, that is.
Yeah.
And
I saw that tweet, David, and you were talking about all the meltdowns that happened because of it, and none of it's happening now, right?
None of it's happening. Well, actually, it is starting again now. You're seeing Turkey's getting into trouble. Turkey's getting into trouble again. Argentina's getting into trouble again. But going back to August 2018, you had a global currency crisis on your hands, and that can quickly morph into a global financial crisis. Well, how? Because all of these countries have massive amounts of dollar-denominated debt. Well, who owns that dollar-denominated debt? The banks. And if there's any risk of default, and you saw this with certainly a number of banks in Italy, which were heavily exposed to emerging markets, UniCredit got, their stock price was cremated. The banks, if the European banks, which are on the hook to many of these emerging countries, but the US is too, but certainly the European banks, the global banking community is interconnected. So if any European bank falls and then another one falls, you get the domino effect. And soon that would spread globally. Now, yes, you could see the dollar spike as a result as a safe haven, but the US is going to get hit as well. And what happened next? The dollar backed off. It eased off a bit. It didn't keep powering up. It went back down to 95, 96, and we've been pretty much around there since then until recently. Now we're back up to new highs, and we see the Turkey and Argentina getting into trouble again. My point is, if we're getting this kind of tension around the world at 97, 98, how on earth is the world going to be able to suffer a 107, 120 Dixie? Somebody explain that to me.
Yeah, we'd be in the most severe deflationary environment since the 30s.
Yeah, you're talking global collapse.
Yeah.
I mean, simply put, because all the banks on the hook for all this debt would go under, and then the banks that are...
Deutsche Bank's chart doesn't look so good.
That's for sure.
I'm not buying calls on Deutsche Bank, but you know what? You brought up these emerging market countries, and I know that you watch everything, David, and that's why these interviews are great. I could ask you anything. I'm a little bit concerned about what's happening in Venezuela, not because of their oil, but because you have boots on the ground from China and Russia in Venezuela and us on the other side, and their reserves are larger than Saudi Arabia. And no one ever thought a flashpoint between superpowers would happen in South America. Everyone was always looking towards the Middle East. What's your view on what's happening there, and are people complacent about that?
Well, this is where I try to keep the tinfoil hat off, but I'll say this: if the global economy, including the U.S., is suffering a slowdown, potentially a major one, and this is a fact that is lost on a lot of people. Nobody's focusing on the fact that the Fed just went from hiking interest rates and reducing its balance sheet at $50 billion a month in Q4. Then we get a stock market drop of 20%, and the Fed immediately flips to, at least on a verbal basis, ultra dovish. Yeah, they're on pause now, but they can't stop talking about all the emergency measures that they plan to use in the next crisis. So that speaks to me, the takeaway from that is the second level thinking. Everything isn't as rosy as these guys are painting. They wouldn't be doing this if the economy was strong. Oh, this is a storm in a teacup. This is transitory, as they like to say. Things are really bad. I've been saying this, you know this, Dale, for quite some time. When you look under the hood of the global economy and the U.S. economy, you don't like what you see. It's negative. I believe we're already in recession. So my point, going back to your Venezuela question, is what's the best way to distract everybody from that?
War.
Let's start a little proxy war out in Venezuela, and that, you know, if there is any meltdown in the economy or in stock markets, you can blame it on a war in Venezuela. You know, that wars are notoriously negative for risk assets. So that's number one. The bigger issue, though,
go ahead.
Sorry, Dale, I just want to make another point. The bigger issue with Venezuela, I tweeted this back when Putin was doing high fives with Prince MBS of Saudi Arabia. The petrodollar, the Saudi-sponsored petrodollar, is at risk. Obviously, Russia and China are becoming great pals with the Saudis, much to the chagrin of the US. Well, now the US is looking for an alternative. They need some kind of backing for the US dollar if the Saudis decide one day to pull the plug. And, they would never do that. Well, look at the prospectus for the Aramco bid, their IPO. It includes a disclaimer saying that, you know, should the petrodollar basically end, these are the risks. So they're already talking about it. And you see how chummy they are with Putin and Xi. So the US is looking for an alternative. There's no better alternative than Venezuela. They have the deepest reserves of oil in the world. So is it any surprise that they're engaged in activities down there? And John Bolton has made no secret of this. And on the other side, the Russians and the Chinese, the chess players, they're not about to allow the US just simply like, okay, we can't rely on the Saudis anymore, we'll just switch to the Venezuelans. They've got them in a nice head hold right now, and they're not willing to release it just yet. So the Russians are putting boots on the ground. They're going, hold on a second. You can't just simply move the characters on the table around. And that could potentially...
Well, the Monroe Doctrine.
Yes.
Right?
Yeah.
It's being violated.
Well, yeah. Yes.
Well, it probably has been for decades anyway, but
exactly.
But it's really obvious here.
Yeah, former Jim Baker, he used to be in the Bush administration. He made some great quotes about that in 1994, how that had been violated so many times it'd make your head spin. But yeah, the fact is that a proxy war in Venezuela is possible. And if in my, I'm a cynic by nature because I'm Irish, forgive me, it's to distract from everything else that's going on. If it happens. So that's my 2 cents on that.
Sorry, I got you off track.
No worries. So we talked about the VIX, and now this is from sentimenttrader.com, which focuses on the smart money relative to the dumb money confidence in the stock market. And as you can see, the smart money has been, as we've known, the institutions have been selling this entire rally on the whole way up, while retail has been jumping on board, because I think the smart money sees the same thing I do, which is there's no fundamental rational reason for this stock market to go higher. So the smart money, as these are at the extreme lows, as you can see. You can just look back and I mean, unfortunately, this is only the past 1.5 years, but these are back to the lows for the smart money, and this is back to the peaks for the dumb money. And it's just another indication of complacency out there. Complacency is rampant after this rally, which is what a bear market rally is designed to do. Dollar yen, this is another signal I saw that worked very well back before the 2008 crash. Dollar yen peaked and fell dramatically. And this is, we all know about the carry trade. And this is the inverse carry trade. Dollar yen dumped and the S&P followed suit. Well, I don't know if you've looked at the COT report for the yen lately, but commercials are loading up long yen. And at the same time, if you look at the daily sentiment index for yen, it's down around 20. So the point that tells me is you've got the large specs are short yen, and the banks, the smart money, are long yen. And then I look at this chart, and then sentiment is extremely negative yen. The risk reward is that yen is going to explode higher here at some point, and that means dollar yen goes south, and that's
pretty tightly correlated with bonds.
Exactly, because the yen is another risk, a safe haven, supposedly. Right. We could get into a whole debate about the yen being a safe haven given their debt load to GDP, but as things stand,
because there are bulls looking for 124 in the yen.
Good luck with that.
Okay.
So I whenever I get into these things, I just follow the smart money, and the smart money is saying the opposite. Okay. So we'll see.
Yeah, that's a big part of your work. You love COT, and it really tells you how people are positioned, how they're sitting, if they're wrong-footed. I've noticed it's a pretty important part of your analysis, isn't it?
Well, yeah, like Stylianos was talking about with regard to the euro pound earlier, I don't get caught in the squiggles. I look for extremes, and when I see extremes in the COT data for whatever asset, and my process is called FIPEST, Fundamentals, Intermarket Analysis, Positioning, Elliott Wave Theory, Sentiment, and Technicals and Trends. And I use a multitude of tools together. I don't just use one. Right. We talked about this. And when the tools all point in the same direction, that gives me warning signs. I focus on data. I'm not interested in emotion unless it's a sentiment indicator telling me that everybody's bullish or bearish. And the data with regard to the yen, for example, the commercials are loading up long, and they have been for a while, and the specs are chasing the price, or have been chasing the price in dollar yen, and are increasingly short yen. And at the same time, you're seeing that the market is bearish yen with a 20% bullish index. So that tells me that the dollar yen risk reward is actually lower, not higher. But sometimes these signals don't work, but I deal with probabilities, and that's what they tell me. And if that indeed does happen, at the same time the stock market is, after coming off a 20% drop, has rallied to new highs, it's long in the tooth. There's no fundamental reason or rhyme or reason for this to go higher except artificial liquidity. I feel a rug pull coming. And whether it's a pullback, and we'll get into this shortly, pullback or new lows remains to be determined, but markets don't go straight up forever or straight down forever, as I said back in December. So the odds are against the S&P going much higher from here without a pullback. So this is short interest. Here's another case in point.
No.
The short interest levels are back to December 2017 levels. What happened in January 2018?
I mean, they've all been squeezed out.
Yeah, so what happened in January 2018?
Yeah.
Just to illustrate the point. Yeah. And then that's just the S&P. Here's another one. This is a great chart. This is the combined short interest of the SPY, the QQQ, and the IWM, the S&P, the NASDAQ, and the Russell 2000. It's at its lowest since 2003. I mean, if that isn't complacency, wow. I don't know what is. This market is primed for a pullback.
Really an interesting look.
Yes, and this is what they do. This is what artificial liquidity does. It squeezes the shorts. Well, they've done a fantastic job. And what have we got next? This is from Lance Roberts and the team at RIA. And this shows profits. We hear about strong earnings. This goes to my point about there's no fundamental justification for this rally. Profits before tax and after tax are more or less the same as they were, depending on which indicator you use, as they were in 2011 and 2014. There's an eye-opener for you.
Yeah. And the tax cut, and then they showed the dotted line tax cut, and they haven't improved.
Exactly. I mean, you can't fight the economy forever, and the economy is saying something completely different to what the market is saying. That all these buybacks are there for a reason. It's to artificially pump EPS and therefore pump stock prices. But if you look under the hood and look at revenues, for example, the story doesn't hold up.
Well, you know,
And
maybe
then,
we peak on the Uber IPO because here's you know they're going to go crazy over Uber, right?
yeah.
Who knows how it's going to go off? You know, could go, you know, explode and fail. But anyway, here's a company that has admitted, you know, all these IPOs, but this company has admitted they don't think they'll ever be profitable. They actually said that. Okay, they say they're a platform.
Yeah.
Okay, and they will never be profitable. This is coming from the company, and watch how people buy it. And with the company saying we're never going to make money.
Yeah.
What,
Define.
does that remind you of 2000 with a dot at the end of any stock?
It reminds me of a whole bunch of things, but yes, that's one example. I would say negative interest rates across like a third of sovereign debt around the world is another one. Negative interest rates. You want to borrow money from me, Adele, then I have to pay you. Sorry, what?
Yeah.
Common sense just broke down there, and then you just gave me another one. This is another example of, well, why are they negative? It's because people believe they're going to become more negative. That's simply it. They think that bond prices are going to go even higher. So even as dumb as it is, and it doesn't meet the common sense threshold, if you think that the asset is going to go higher price and the rates are going to go even deeper negative, you buy it. Well, the same with Uber. They're never going to make any money, but I think the stock price is going to go even higher because I am oblivious to all the data in the market. I'm going with emotion, and everything tells me it's going higher. So,
and they gave me a ride to the grocery store.
Oh, I think fantastic service. Every time I have to bring my car in for a repair, I use Uber.
Yeah. All right. So this is the highest reading ever for this indicator.
Yeah, this is the Crescat micro model, which is based on 18 proprietary indicators that they use, and it jumped off the page at me because it signaled the peaks in stocks in the late 1990s. It also signaled the bottom that followed in the 2000s and back in 91, and then the subsequent peak in 2006, 2007, the bottom in 2009. I mean, it's got a perfect track record so far, and look what it's saying right now. It's saying what everything else is saying, that get the hell out of Dodge. It's extreme overvalued. Now, could this signal not work this time? Sure, it could. But when you start putting all of these pieces of data in, how can you ignore it? Oh, because I'm long. That's why I ignore it. So anyway, that's the, I think it's that's.
So let me just take a shot in the dark here.
Yes.
You're bearish the stock market.
Oh no! What made you think that, Dale?
I mean, just a lucky guess, David. So you presented one of the best bear cases I've seen in a long time.
Well, thank you, Dale. And this is a key point I want to make here. I'm bearish the stock market, but I get trolled all the time on Twitter. Well, how's your portfolio doing? I'm not short.
Yeah.
I'm not short because I'm a trend follower. So what I'm doing is I'm waiting for this to peak, then I'm waiting for it to break support, and then I'll jump on board.
Okay.
And that level I'm currently looking at is 2860. If we break 2860 to the downside, would follow through below 2785. See ya.
And you need volume, right?
And volume, and that's another. I haven't even got volume here. Volume's anemic in this rally.
I had a guy on. We had a high volume day. I think it was March 22nd, and he said if we have another down day with that kind of volume, that's his go. So, and that was based upon Spider, I believe, David.
Yeah, and that plays into my thesis. That plays perfectly into my thesis, Dale, on what the peak and fall here shortly. I think, as I said, I'm looking for slightly north of 3,000 before we peak here, which would tie into another big volume day, 30-50, 30-30, whatever it is, and down we go. But
on a trade deal, maybe?
Yeah.
Yeah, I know. It's symbolic. How about if the Chinese, they don't, look, you've talked about China with me several times about they think in terms of 100 years. You know, we think in terms of election cycles here.
Right.
So why do they even want to hand Trump a symbolic victory?
Oh, but I think it's a mutual interest issue here.
Okay.
It's not just about helping Trump. I don't really think that's the issue. I think
I mean, they would be okay without a trade deal, wouldn't they?
Well, exactly. I mean, I've said since day one that the Chinese are in the driving seat, and I got trolled tremendously on Twitter for that. But it was obvious to me because, look, the US were enforcing demands, were making demands on China. Have you never known a Chinese leader to cow down to a foreign power saying, do this, do that?
No.
It was obvious from day one that Xi was never, ever going to lose face by cowing down to the US and Trump's demands. Ever. And look at what they were asking for. You're not allowed to continue with your China 2025 plan. You're not allowed to provide subsidies to the industries that you're promoting. And this goal of, being your growth goal is, we find it insulting, basically. And the Chinese were saying in their media, and I read the Chinese media to get the other side, they were saying that US is trying to curtail our ascent. They're trying to slow us down. That's what this is all about. And to some extent, it's true. Now, the IP issues are valid, but you're not going to be able to dictate to China. China consider themselves on a par with the US. They don't consider themselves a little minnow, and certainly when they've got the Russians in their back pocket as well. So it's never going to happen. Just take a stand back from the weeds, go to look at the forest, and it's just obvious to me. And when I see these trade deal headlines and Kudlow rolling them out, I try to go on Twitter and mute the word trade deal. I don't want to see any more tweets about it. I'm so tired of that nonsense. It's just solely to drive algos. And it works because they're machines and they can't detect bullshit. But that's all it is. There's no rhyme or reason. And look, there's this story, a kid story called Cry Wolf, and that's what we're getting. They're saying, trotting out the same headlines forever, and they keep punting it down the road. And it never comes to fruition, and I don't expect it ever will. The only way this gets resolved if the US climb down, and I've never known Trump to climb down, but we'll see. So this PowerPoint is with regard to the China stimulus. I was making a point there recently that, why haven't the blackouts caused stocks to fall again in January and in April, David? You were saying they caused it in October. Why? Well, the market was saved by China. China did massive stimulus in January to help the market get out of the doldrums to the tune of 5% of its GDP in 1 month. And then I was shocked to see them do it again. They announced it again in March, just ahead of the next buyback blackout. Now, again, liquidity is all that drives stocks. And this is certainly a factor. They filled the gap left by the absence of buybacks. And but the problem is now Xi came out after this latest one, and if they're true to their word, which is not always the case with the Chinese, he said that they're done with this stimulus. So we'll see how the summer goes, but it's not looking too good from a liquidity perspective if the Chinese aren't around to bail out the US when the next buyback window comes around.
What about the signal we're getting in copper, David? I've been negative up there at that $3 level, and this looked like a pretty severe breakdown this week. That's implying? I mean, to me, that doesn't imply strength in China.
No, it doesn't. China's the biggest commodity buyer in the world, and
so what's going on with copper breaking down?
Well, the global economy is slowing.
Okay,
it's confirming what we already know.
Okay, so Dr. Copper, I said, Dr. Copper is in the emergency room because he's being sued for malpractice for impersonating a bull market.
Yes,
what do you think?
He's in there with nat gas and soybeans.
Yeah. So, can you see like 220 copper down the road here?
Well, I did say that 225 is possible if we get another deflationary crash. Certainly a big pullback coming, but
and that's not really cheap copper. I mean, see how our things have changed. I was a commodity broker when it would trade 70 cents.
I know, and then China showed up. But and then aided by the US and the exorbitant privilege, but a whole other debate. But yes, the copper And I have to make a comment with regard to soybeans. Nobody gives a hoot about soybeans. Soybeans are the best indicator out there of the possibility of a trade deal. Simply put, I've been saying it since the dawn of time. Every time it looks like, initially when we didn't get this cry wolf scenario, soybeans were popping ahead of positive headlines of a trade deal because China imports a ton, many millions of tons of soybeans from the US. And then it dived. Well, now we're still getting these positive headlines, it seems like daily, as Sven Henrik likes to say. And soybeans are getting crushed right now. They're saying there's no way in heaven this is happening. Just go pull up a chart of soybeans.
Yeah. And DSI is like 9. I don't think I've ever seen it there.
Yeah. So my point is that you got to look at the data and ignore the BS that you're seeing in the media. And the data is telling you the actions of the traders and investors and the big money is telling you there is no trade deal. Now, we're back to copper. Copper isn't alone. There's other signals. Oil is a very manipulated market. Let's be honest. It's controlled by a few big producers in the world. But copper is telling you that the global economy is slowing, and that shouldn't be a surprise to anybody, as far as I'm concerned. Yeah. So trying to get through these. So this isn't just me being bearish. I got a few friends, just like I did for the 2018 call. Jeff Gundlach, he expects the market to be negative year to date by the end of the summer at the latest, and that means that he expects the stocks to peak sometime in May or June. And he's not alone either. Russell Napier, deflation, inflation. I couldn't agree. Well, I've said this before. He came out with this, but it's nice to see somebody of Russell Napier's caliber come out and say it. No QE, no bottom. If the Fed wants to return to QE because they need to reflate the economy, they need to inflate away the debt. They have to. So the QE is inevitable, in my opinion. MMT is too, but to the extent that they need an excuse, and that excuse, a pullback's not going to provide it. I'm getting ahead of myself what I'm going to say later, but a pullback's not going to do it. A crash would do it. A crash is an ample excuse, a 30% drop to new lower lows, and you will see the Fed return to rate cuts, QE, and what I call monetary insanity on steroids. And Russell Napier expects the same. He's basically saying that the Fed needs to go back. They need to inflate away the debt, and in order to do so, they need a recession or some kind of deflationary event to enable them.
The pain of deflation. So real estate prices be affected by that too?
Yeah, but only in the retail price. Real estate prices are already getting hit hard, but
are they? Not here yet.
Well, no, you're seeing we're down around 20% in Toronto, and I'm seeing it in areas like California is maybe still going up, but the slope is down. And actually, I saw a chart recently show it's negative for the first time since 2007, I believe. But the point is that it could go down a little further, but then lo and behold, the central banks, especially the Fed, are allergic to deflation. They will ride to the rescue. They made that clear. They're talking about negative interest rates. They're talking about policies they previously turned down, using any emergency measure to turn it around. They will throw the kitchen sink at this, Dale. And that's why when we get this sell-off, whatever it's a pullback or new lows, I'll be buying, because these guys are going to pump stocks like to a blow-off top around 4,000. We talked about that in February of 2018, you and I.
We did.
And I still expect that to happen. Larry Fink, one of the best contrarian indicators out there. I think the chart says it all. He comes out at the peaks with all these optimistic.
How does he keep his job?
Oh, I don't know.
Because he's the CEO. Why did they keep him there? Because maybe he's their contrarian indicator, and they get short every time he says it.
Well, I was going to say this is what he says publicly, but in private he's doing the exact opposite.
Oh yeah, that's right. He needs people to distribute his position to.
Exactly. So the latest comment is he sees a risk of a melt up, not a meltdown. Okay, sold.
Yeah,
that's yours. I'll give you all my stocks. There you go, Larry. Yes.
Okay.
See you later. Now technicals, this is from Sven Henrik.
Yeah.
And I won't get into the details of this, but basically you can see the trend lines working.
Yeah.
But these are long-term trend lines. This chart goes back to 1987, and you can see the connection of the troughs and the connection on the peaks going back to 2007 and 2009. And
that's a beauty.
Look at where they meet, and then look at the line down the middle between the two, and that level at the top there is just above 3,000, and it occurs, and the timeline is October. And we'll get more into that in a minute, but this is a technical indicator going back years, and it's got multiple trend lines that all intersect at the same point. It would be amazing if this plays out exactly as predicted, and you see a major drop from here.
Nice.
And then you've got from him and his wife Mela this megaphone pattern, which I've seen elsewhere too, showing again a move up to just above 3,000, but then
down to 2150,
and then down to 21 to 2,200, which has always been my target since day one. Be interesting to see if that plays out too. But that's technical basis for what we've gone through. A lot of data and intermarket analysis. Here's the technicals. Now let's talk about Elliott wave theory. This is the count I have for the stock market rally since it bottomed in March 2009, and we completed wave 3 there at 29.41, and some people believe that this wave 4 drop to 23.46 that's the correction. We're done, and off we go in wave 5. We're in wave 1 of 5 now, and wave 2 pullback will follow. The problem I have with that, I have several problems with that analysis. It may be true, but here are my problems. I don't think a pullback is going to justify a Fed reversal in policy to rate cuts in QE. I think they're going to need more than that. The multitude of signals I've just gone through suggest the next downturn is going to be bigger than this. There's just too many signals saying we're going south, and there's so many people that have been sucked into this market. So many retail players have been put in. The complacency is widespread. It just seems ripe for a deeper drop. But most of all, from an Elliott wave theory perspective, look at the wave 2. Back in, it lasted 3 months from May to July of 2010. And that's your wave 2. And it's a small little drop and it lasted 3 months. Typically in Elliott wave theory rules, if wave 2 is small and short, wave 4 is big and long. That's just
alternation, rule of alternation. Okay.
Exactly. Well, wave 4 was from October to December. It was 3 months. Now, yes, arguably it was bigger than wave 2 in terms of size, but it was the same duration. I'm leading to the second scenario for the reasons I mentioned and the Elliott wave rule, that we've got another leg down coming. And
so new highs could be what they call an irregular B because it takes out the high of the previous
expanded
high.
Flat. That's expanded flat.
Oh, there's Steve Volge.
Yeah.
Expanded flat. And there's another reason for that. If you remember, Dale, when I provided my forecast back in February 2018, I said that I believe that we would go up to 3,000 or slightly above, 3,000 plus, and then fall. Well, we fell short of that. We got to 29.41.
Right.
Typically what you see in Elliott wave theory is when the correction comes, if the market has missed a predetermined target based on Fibonacci levels before, on the B wave level in the correction, it goes up to hit that level to fill the gap it left behind. It should have visited 3,000, 3,050. It did not. It fell short of it and then fell. The next time around, you get an expanded flat, as Stylianos was saying, and it fills that gap and then it goes south. And that's what I think is playing out here. And the MACD, for example, here, the long-term MACD, this certainly looks to me like it's going to go back up to the signal here and then turn south again. And that'll create much more energy for the blow-off top, I expect, when the Fed reverses policy. Because as I said, I think you said you're a bear on, you're bearish the S&P. I am now, but I'm not a perma bear. Once we get this peak and fall, I think we're going to 3,500 to 4,000 on the S&P next. You know, so this is a buying opportunity.
And that'll be with a big bear market in, that'll be the reflation trade. Everything goes up except probably bonds and the dollar.
Well, actually, I would include bonds because the Fed's going to be buying every piece of debt.
So bonds could survive a massive round of QE.
Yeah, but they're going to have to throw the kitchen sink at this, which I fully expect them to do.
But the dollar won't.
No, this goes back to Luke Roman and another Irish chap called Lewis Curran. They came up with this US trilemma theory we talked about again back in February 2018, and it's basically this: the Fed has it will
sacrifice the dollar to keep the game going.
They have three areas of focus, exactly. They have three areas of focus: stocks, bonds, and the dollar. Well, stocks are key to the economy because the U.S. stock market. Yeah, the U.S. stock market is 150% of GDP. A massive amount of the tax receipts are taxes on IRA distributions and capital gains taxes. So it's key to the budget. So they can't allow stocks to fall. The U.S. would become insolvent because their revenues would dump. Or at least the perception of insolvency. Well, it is insolvent. Let's be called a spade a spade. The bond market is also key because of the sheer amount of debt and how fast it's rising. If interest costs on that debt balloon, and the CBO has already expected it to become the biggest expense on the US budget by 2030, but if yields spike higher, you can move that date forward to 2020, 2021, because the debt is so big, and if the yield increases dramatically, so does the interest cost on their budget. So they can't
let it happen.
They can't let stocks dump, and they can't let bond yields spike. So they have to prop up bonds.
Sacrificial lamb is the dollar.
The dollar is obviously going to be thrown on this sacrificial altar. Yes. Okay. And that's what's going to happen. I fully agree with that thesis. So that's what I expect. They're going to throw the kitchen sink at this, and the S&P is going to go to 4,000. I think everything else goes up, and this goes back to gold and silver. Gold and silver, if you're debasing the currency and the dollar does crash, along with every other currency in the world, even if they look the same relative to each other, when you go out to buy a can of Coke, it costs you like $10-20. The gold and silver are a hard asset that are going to explode higher, and it doesn't matter what the paper markets do because everybody will want it at that point. But we're getting ahead of ourselves. But that's my anticipation.
I'm stacking it now, bro.
Yeah, well, you and me both.
Okay, so anyway, David, you know what? Let me ask you this, David. Why don't you show your website for people that I know this was a great interview and people are going to want to stay in touch with you on Twitter and go into your website. And you have chat rooms and you do this during the week, a few times a week or something like that, where you get together with your subscribers.
My wife says 24/7. It's too much, but no, I'm on it every day.
You're helping her with the new baby. I know you're helping her.
Well, we got 4 kids now, so there's 4 of them. So but this is my website. I'm on it like daily, and it's globalprotraders.com. You can find me at globalprotrader on Twitter. But it's a free market forum for people to exchange reviews in the markets, and based on any data tool that you choose to use, all opinions are welcome. And because it's an extension of my own methodology, which is to use multiple tools instead of focusing on one. I'm not a purist on Elliott waves, technical analysis, fundamentals, sentiment. I like them all because they've all got merit. And when you have all those tools say the same thing as they did in gold back in December 2015, it was going higher. It was a no-brainer as far as I was concerned. Load up, and that's the thesis. That's the core thesis of my process and this site. And I welcome anybody to join in. It's free, and I think my members have found it to be great use, and I found it to be great use too because I can't see everything. And these guys are like my little army of a big army, I would say, when he's little, that go out and they're reading articles and they'll post them in this chat room.
Yeah.
And there's some great nuggets. I got one on gold yesterday talking about how the physical holdings of the ETFs, particularly GLD, are being drained. And the reason they're being drained is the bullion banks are having difficulty meeting delivery requests, and they don't want to spike the market by having to go out into the open market and buy the gold. So what they're doing is they're raiding the storage areas of the GLD and the trust companies' holdings. And I found that, like, and these are not like just willy-nilly guys. These guys have been reporting on this forever. And those are the kind of nuggets that you get at this site that I find extremely valuable, because the day when physical scarcity overwhelms the paper futures market in gold and silver is when it truly explodes higher.
Which is inevitable.
Well, David, you're doing a fine job. I consider you a watchman for the community, the trading community, investment community at large, by sharing your views and collecting intelligence, and really appreciate the time that you spent. It's a new record as far as time, and it's one of the best bear cases presentations I've seen maybe since I started doing FACE. So appreciate it. Thanks for edifying our community today, David.
Thanks David. So much. Thanks, guys. One last comment. These downtrends in gold and miners, watch for a break of the downtrend, the lower and lower highs for the next break up, in my opinion. I completely agreed with Stylianos' read on it earlier, and I said so in the comment section. But you can see that there's a clear downtrend. When you see this downtrend and you see a previous high broken, that's a warning sign that these are going up. And thanks very much for having me on, Dale. I always appreciate it. It's great talking with you guys.
Okay, David, my trading warrior brother, David Brady, what a way to wrap up the week. Manny, thanks you, David, Giars, and Leopold, and this will be out on Twitter in a few hours. So, David, have a great weekend, good hunting, and let's get back in touch later in the summer, fall, and see how things are playing out, and really appreciate I learned from you today. So, thanks, my friend.
Thanks very much, Dale. I really appreciate it.
Okay, guys. All right, so everyone, don't just count your pips, count your blessings. You're welcome, Amir. Have a great weekend. Do your homework so you're not impulse trading next week. Thank you, Steve Volge. Thank you, Blake. Thank you, Grega. Thank you, Joe. Thank you, Amanda. Thank you, Stelios. Thank you, Andre. Thank you, team. Best team I've ever been part of. And you guys should become part of it too. I'll see everyone on Monday. Adios. Enjoy. Smell the roses. Money comes and goes. Time is gone forever. Make it count. Smile. Adios.